Mate, Stephen Wood, Eiger, is it Eiger Capital or Eiger Cap? We just call it
Eiger Capital.
Eiger Capital.
You know what the Eiger is?
No.
You don't?
Like the, oh no, I'm thinking of geyser. No, what is it?
It's a mountain.
Yeah.
So
Mountain of cash.
just a very big rock climbing mountain. It's in Switzerland. My two colleagues and I have worked together now for 14 years. We used to run a small companies fund at a big Swiss fund manager. So when we ended up setting up Eiger, we wanted something Swiss. And we didn't fancy chocolates or cuckoo clocks, so we went for a mountain.
Or knives. The Federer Fund. Well, yeah, you got a few bucks under management, eh? One bit over $1 billion?
Just on $1 billion, yeah.
Yeah, right. We want to go in the weeds today of whether you hold it or not, of what you think is interesting. I think we're covering every bloody commodity today, between uranium, gold, coal,
lithium,
battery metals, mineral sands, battery metals,
rare earths,
rare
earths.
Mate, she's talk about a bloody one-stop shop.
Around the grounds.
Around the grounds, right? Where are we starting, Steve? I think you've actually developed you got a bit of a flow of how you want this
You're
journey.
guiding us through this.
You want this next hour, this journey to go on.
I trust JD to guide us through this.
Right.
IGO, I reckon that's the place we start. And I heard you in a podcast a couple months ago had a couple comments about the sort of competitive in the industry, what the structure is going to look like perhaps in a few years' time. And you were speaking to the fact that you think there'll be a few, a small handful of players that'll...
Yeah, so there's a couple of papers we did that are on our website, and they kind of got the quirky title of Devil Takes the Hindmost, which is a great book. You may have read it. It's about bubbles and stuff like that. And Devil Take the Hindmost basically means don't be the last man left holding the baby when the music stops. And the article we wrote basically compared the iron ore boom, both in iron ore and then obviously in and around the share market, in sort of 2003-4 through to about the GFC, 2008. That obviously picks up the sudden need for more iron ore as China puts down a lot of infrastructure, and the rise of Fortescue from essentially nothing to what it is today. And then during that period, and we list a whole heap of them in that article, there must have been 15 or 20 iron ore juniors just came and went. Some of them, a la an Atlas, got to about 4 or 5 billion in market cap. And then ultimately over the course of 2008-9, post the GFC, bit of a wobble, they mostly recover. By about 2010-11, they're pretty well all gone. And we kind of put forward the speculation, this is back in 2022, that lithium will probably go the same way. And so our view of where we're going to end up with lithium, particularly now that perhaps around cars in particular, the industry looks like it's going through a bit of an S-curve. It's jumped up. It looks like it's flattened right out now. Demand's still there, but it's not growing anymore. There's a lot of incentives now to get EVs to move. Probably the next generation of consumers are a bit more circumspect about charging. Do I go on holiday? Do I get stuck somewhere? And I think we're starting to see that play out everywhere. The US, the markets that matter, the US, Europe, here. And so the demand for lithium's kind of flattened out, and the price, as we know, of spodumene has gone from $8,000 a tonne a couple of years ago to sub $1,000. It's now started to recover. We've seen, in and around the share market in Australia, where there's a lot of listed lithium mines, as there was in iron ore in 2005-6, wipeouts all over the place. Mining companies in the space now struggle to raise money. Some of them stop mining. And in fact, we're going to be watching with interest to see, how Liontown goes when it starts mining, in the June quarter. So it'll be fascinating to watch, which then brings us back to IGO, which as a stock that traditionally has been a nickel miner with Nova and then the acquisition of Western Areas, which they paid a lot of money for, happens to own 25% of Greenbushes and 50% of the Kwinana hydroxide refineries. So IGO's share price has halved, as we all know, since about June, July last year, so in less than a year. And it's halved because Nova doesn't have long to go, a couple of years. The nickel price has been under pressure, and there have been obviously ongoing discussions about government support in the papers, and there's been discussion. And the acquisition of Western Areas has basically copped $1 billion write-down. So, from where IGO's shareholder sits, that's been a bit of a disaster. And then, of course, the spodumene price has come from $8,000 a tonne to sub 1,000. It's now recovered a bit. But in our view, the end game here in lithium, if there's going to be an end game that looks like iron ore, is there needs to be a couple of big producers and then a whole lot of other people. And if we were to take a bet right here, right now, the two big mines that are going to be there supplying the bulk of the world's lithium, and it's not a market that's, it's a fraction the size of iron ore. So the two big players that are likely to be there at the end are going to be a Greenbushes mine that in the next couple of years expands from the current 1.5 million tonnes up to about 2. And Pilbara, who've made some announcements today on their progress from 500,000 tonnes to 1 million tonnes. So there's your 1 million tonne and your 2 million tonne mine, and the rest of it is either small and yet to be proven, and who knows how that will play out, or it's still running evaporation ponds, which in our view, while they have certain cost advantages because you don't have to pay for the sunshine, are also less reliable and less likely to deliver consistently large tonnes week in, week out. So we think IGO is interesting because essentially you've got, you've had the broom through the place, you've had the write down of Western Areas. We're not so sure about the outlook for nickel. A lot will depend on, subsidies and how the industry plays out in Indonesia. Let's just sort of say we don't really know how that's going to work. The factors are largely beyond the management of IGO's control, but Western Areas is written off. It's on care and maintenance. Nova is not going to cost anybody any money anymore. It's got a couple of years to go, and now you've essentially got an IGO that's halved in share price. If you're simply making the positive case here, it is that the lithium price recovers from the sub 1,000 back above 1,000 now, recovers a bit more, and then all of a sudden Greenbushes is making a fortune again. That's your bull case for IGO.
What do you think the role of Wodgina will be? Like you said, sort of, you're going to be looking at Pilgangoora and Greenbushes as the two biggest producers. Do you think, is Wodgina looking like it might not last that long, or it hasn't got the quality?
No, we would rather, I think if you had to pick the third player, it would probably be, the Wodgina MinRes ecosystem. It's up and running. It's backed by people with deep pockets. But unlike Greenbushes and unlike Pilbara, and we'll have this discussion again when we get to uranium, kind of the trick with a lot of this is not only to get a good resource into production, but you've got to get it, like Fortescue, you've got to get it into production at the right time. When you just jag that piece of time, when the commodity price just hits a purple patch, when suddenly China comes along saying railways, bridges, property, I need iron ore, and then BHP, Rio and Vale are going, right, well, we can now invest heavily to get production up, and Fortescue just happens to have already been partway through their development phase to do, some certain type of style of mining that people didn't think was possible. And at 20 or 30 bucks a tonne for iron ore, it probably isn't possible. But 80 or 100, what they originally came with absolutely works. So
what is their style?
Well, it was that flat plane mining that they came out with early on. They've obviously developed way beyond that now.
Yeah.
But, if you recall, pre-GFC, some of those deposits were at $20, $30, $40 a tonne for iron ore. No one wanted them. But that's not the price of iron ore anymore. And so Fortescue gets going, gets the cash flow, has problems, but because they're in business at the right prices, you get to plaster over all the cracks. And then you go and go and go, and you build your infrastructure and you cut your costs and you go again, you go again, you go again. And now look what you got. Meanwhile, if you were 3 years late at getting into production and you're suddenly dealing in the iron ore market post-GFC and you need to raise working capital, you just don't make it. You may not make it. And in fact, with iron ore, none of them did.
Bloody lucky the iron ore majors made it, not the small ones. Because could you imagine if DSI didn't have the iron ore to supply this, to make the steel, to make the DSI bolts and mesh? Fucking wouldn't the world have stopped?
China would have stopped. DSI would have stopped.
Underground mining would have stopped.
Fallen in everywhere.
Kiss goodbye your fucking iPhones, your Samsung Galaxies, your EVs, even your non-EVs. Like, pretty much. Okay, if iron ore's strong, that means DSI is strong, and which means the world is strong. Planet Earth is strong.
Yeah. I just sometimes wake up from a nightmare, Matty. My nightmare is I'm stuck in a mine that's not using DSI ground support and it's just caving in on me.
You imagine if they weren't using any ground support because there's just no iron ore. It goes beyond that trap. So look, those Australian factories, the DSI factories, pumping out DSI ground support have kept the world imploding. What is it, JD? Go Australia.
Go Australia. It's a turnkey solution, mate. It's a win-win.
It's a
Call
win-win.
DSI.
Chuck it on the DSI. In the case of like of IGO, how do you weigh up the downside risk that comes with the non-controlling joint venture interest? In a lot of, like, you can point to some kind of bizarre things that must only be happening because they don't have the right to say how things go in that joint venture. And
They don't.
One instance, I mean, when does the world's lowest cost producer be the one that curtails supply, right? That doesn't make sense, like logically. And then they sold some stockpiles with 180-day payment terms. Like, in what world are 180-day payment terms like the norm unless, you're hamstrung?
Look at it.
Yeah.
The choice you've got to make if you're an investor is, do you go with that, with a share price that's halved, or do you go with a mine that's probably going to fail?
Pilgangora.
What do you mean?
Well, the option. What
You mean
IGO?
you're talking about Pilbara now?
Well, you said there's only two options, like IGO or like Pilgangora is not going to fail. That's another option.
That's true.
Yeah.
Well, Wodgina's not going to fail.
Yeah,
Pilbara is there forever, as in Pilbara Minerals.
but it's a valuation play. Like,
Equally, I mean, those at the end of the day, to us, are your choices.
you look down the
yeah.
line for value because
Your choices are
yeah,
Pilbara and IGO.
yeah.
And yes, IGO's got warts on it, but if you had to weigh that up, if you're us as a small mid-cap investor and you had to weigh that up with a share price that's halved, and yes, to some degree, they're a semi-passive holder of the world's best lithium mine.
What do you look at with the nickel assets? How do you? I know, as you said, they've been written down, but do you see? Is there any potential that they could maybe get a bit of coin from private equity for Cosmos or keep it on care? And I know there's still more capital, to tens of millions, to go out the door to finish the ramp down, but have they got, what options have they got? Because you're scratching over in Forestania because they're finishing.
Well, Nova doesn't have long to go.
Yeah, and neither's Forestania.
Well, Western Areas at where are we at? $9 $9 a pound at the moment. It doesn't work. So
are they going to hold? Do you think they'll hold Cosmos for this? Maybe if prices bifurcate in the future, but it won't be easy to go back into. Or do you think they'll flog it off?
To our way of thinking, just concentrate on if you're going to look at IGO, it's just about a recovery of $500 or $1,000 a tonne in the spodumene price, and that's all that really matters. Do you get lucky? Maybe. Who knows? Nickel just looks hard.
What about the decision to, and obviously they bought into it, but they have the downstream in Kwinana, which is, compared again to Pilbara,
Yep.
a decision they actively sort of steered clear of by and large. Obviously they've got an arrangement with POSCO now, but what do you make of the future prospects in Kwinana? And if you were the manager, would you encourage them to keep putting capital toward it, or?
Well, the most important thing now is to get it working properly to start with. And I don't know what you guys would think, but you probably want people to prove they can walk before they run. You don't want someone pouring huge amounts of money into something until they've got, step one working as it should. So at the end of the day, for us, right here, right now, as an equity investor, the share price is halved. Nickel's on care and maintenance, can't hurt you much anymore. And they've got the world's best, they own 25% of the world's best lithium mine by a margin. And it's already paid them back. The question is, the bull case for us on IGO from here is, if the lithium price can recover, they are in production with a low-cost mine.
Well, since it's a pure lithium, it's a bet on the lithium price. How do you view if Lithium Americas, like if Thacker Pass, like the sedimentary mine improves up, and then there's more ponds and everything, like in terms of the amount of lithium that can supply globally? The
world, whether it's oil or lithium or uranium or just anything, is awash in everything at the right price. It's got to be at the right price at the right time. And from our point of view, once again, we go back to that iron ore thing we did. If you look at the thing as an investor from our point of view is, if you look at iron ore between 2004 and 2008, and the numbers are in the study that's on our website, but I'll just pick them, from here, and I may have these numbers slightly wrong. I think since then, the global seaborne trade in iron ore has more than doubled and possibly tripled. So where are all those juniors? Like, where are they? If you'd said back in 2005, we're going from 500 million tonnes, 600 million tonnes of seaborne trade in iron ore to 1.25 billion or more in 10 years' time, how many of us sitting in this room in 2005 would have said Fortescue's going to survive and quadruple in size, BHP will double, Rio will double, Vale will improve a bit but not go too far, and then 20 of these companies are going to get wiped out? Who would have said that?
But is it on the barriers to...
No. Who amongst us would have said that?
It's a tough bit to make.
I think it's pretty logical, to be honest.
They'd all go broke.
Well, it's an infrastructure. I mean, everything seems clear in hindsight.
The volume of seaborne trade in iron ore would triple, and every single one of those companies that raised money between 2004 and 2008, bar none, including Atlas, is going to go
Atlas would
bust.
To put debt in their capital structure when they're a high-cost miner.
Went bust.
Yeah.
Who would have picked it? But they did.
I don't know. I wasn't following markets in 2008.
So why is lithium going to be any different?
The barrier for entry is so different in the lithium, but compared to iron ore for the capital. Look at Develop's the scope and study they put out for Pioneer Dome. It looks like they can put a float plan in there for a couple of $100 million. You're mining something that's $1,000 a ton compared to something that's $50 to $100 a ton. So it's the capital barrier, I think, is why
very
I
different.
think that's why the journey might be a bit different.
Yep. Yep. And you don't think at 2 million tonnes a year or 1 million tonnes a year in the case of Pilbara that just gives them advantage to recycle. That means that they just keep mining forever and grow, and the other stuff just comes and goes and is all a bit marginal, just like iron ore.
I think the other one is like the fact with there's going to be a bit of a ceiling now, or possibly, who knows, but a ceiling on lithium, because like China's got this reservoir of lepidolite they can just turn on and off whenever they
so pick a number,
want.
1,500, 2,000?
I reckon everyone would take 1,500, wouldn't they?
Okay, so where does that leave everyone?
I think
apart from Pilbara and Greenbushes and a couple of others, where at 1,500, where does that leave everybody? Broke?
I reckon. I think 1,500 would bring on a lot of smaller ones,
like small cap lithium companies. Yeah.
I think your smaller ones would operate it. Well, Pioneer Dome's an example.
Yeah.
That look, the study says that it can operate at 1,100.
Sure.
Like it'd definitely look at it like it could operate at 1,500.
Oh,
so but like all those smaller ones won't have that much of an impact on the.
Yeah.
on the supply on the global supply either.
But it's the Q1 cost quartile asset that endures the cycle irrespective of price and accrues a greater proportion of the upside.
Right, whether Stephen's right or I'm right, just either way, just get yourself into a game with an ore body. Miners out there, got to be in it to win it, and K-Drill are the bloody thing to find it for you.
Ooh, yeah.
Mate, you got a 1 rig or a 2 rig contract coming up, just give K-Drill a call. They're the WA exploration specialists. Bloody emails in the show notes. Great culture, great safety standards, absolute elite sample management.
100% success rate.
100% success rate of superior sample management and drilling of holes. And you know the best thing, boys?
Tell me, Matty.
Fresh off the shelf here, check out who works at K-Drill now.
I'm Drew Harvey and I am the Business Development Manager for K-Drill. Yeah, big thing was culture. All the right tools in the shed, your rhinos, your Steves, Paddy, all the people that approached me made me want to be part of it and grow it into something special.
Now, Drew, talk about coming in for a layup, Drew Harvey. We've been on this shit for the last 9 months. So, look, Drew, if you're listening, mate, we've done all the work for you. Let's do a metaphor. We've essentially spent 14 hours cooking a fucking brisket on the smoker. Drew, all you got to do is put it on a plate and feed it to everyone.
If Drew Harvey calls you, be like, hey, I heard your money mine. Those guys are good.
Yeah. Geez, they made your life easy. We're about to call you. Just bloody go K-Drill, go Australia.
Good footy.
Go Australia.
So, Stephen, to relay that into another, basket of commodities, rare earths that, similarly flew through that 2021 period and have come crashing back down. You've got, companies like Lynas, which I know you're familiar with, and they're also seen as a company with a strong sort of moat around their business, them and MP Materials in America being the two, preeminent Western players. Mm-hmm. Do you think a tie-up there eventually happens? That's been rumoured in recent months.
Well, it's got, and you talked about before, can there end up being two lithium markets? Sorry, two nickel markets. Well, the only hope you've probably ever got of ending up with two rare earth markets is if you would think, or the possible way it can happen is if Lynas and MP was to merge and the Western world says, all right, we're now going to buy our rare earths off them at this price, at a minimum. And then the rare earths price doesn't, perhaps like nickel, get forced to go through these cycles depending on what a few people think or try to wipe out their competitors at a given point in time. And Iluka have actually made some comments about that literally today.
Yesterday's AGM, yeah.
So, does that happen? Does that not? But the other thing that's different with Lynas compared with MP and everybody else is they've put $1 billion and 15 years into learning how to process and separate rare earths, and actually no one else can do that. They are literally it outside of essentially China. So everyone else can mine it or can stockpile it. No one else can sit there going, there's NdPr, there's heavy rare earths, there's your little bits.
Yeah.
And because that is, remember that plant that's sitting in Malaysia, correct me if I'm wrong, but when did they turn that thing on? 2005? 2002?
It had an ugly ramp up. I think it was 07.
Very ugly.
Yeah.
There's $1 billion or more gone into that in working capital as well as capex. So that's not easy to do. Now you talk about a moat, but you've got that plant. You've now got Kalgoorlie cracking and leaching coming online, and the US government have given Lynas $250 million US because they obviously. And by the way, that's not a loan. That's a grant to start establishing that plant in Texas. So you would think if you chucked in a US listing and Mountain Pass's deposit, that you then sort of almost got a US company. Sort of. It's a US Australian company, but you can sort of see that the more assets you get on the ground in the US, the more likely you've got that US ink, for want of a better term, around, the Inflation Reduction Act kind of goes, well, the deposits in California, some of the processing is in Texas, there's a bit else that gets shipped out from Australia, but that's cool because they're good guys, and here we go. We've now got homegrown rare earths, which we can now start adding downstream to.
We've had a former guest of the show, Kingsley Jones, and he's done some wicked analysis on the pathway all of these separated products take through the world, and even as the separated rare earth oxides come out of the plant in Malaysia, eventually all this.
Well, someone's got to make you a magnet.
It's sold to Japan. It all goes through China at some point. And
that's
then
it.
MP Materials have done, I think, definitely more work than Lynas when it comes to the magnet manufacturing sort of work, like completing that downstream stuff. And when you look at the potential, merger of these two companies, you've got Gina, greater than 5% shareholder in each time, maybe trying to affect an outcome. You have a potentially monopolisation of a particular market in the West, and greater magnet downstream, like.
Well, you need more magnet. You probably need places like Japan and or the US to invest, or in the case of the Japanese, invest more, or in the case of the Americans, invest some in making, rare earth magnets out of NdPr. The other side of it's fine, because the heavier earths go into all sorts of bits and pieces in small amounts, and essentially you just need the minerals. But in terms of making the magnets, you need more people to make magnets.
I'm intrigued by the long Lynas. Like when people hear about a rumor of a deal, the hedges will go, I'll buy the target and I'll short the acquirer, thinking there'll be some premium. But in this one, they're relatively similar market caps. You long Lynas just knowing that the synergies will be great. Yep. More market power, and even if there's a little premium paid, you're happy.
Well, and what you're hoping is it sort of Americanizes itself, because at the end of the day, that's where the bucks are. They're not here. No one's going to build a magnet factory in Australia, despite what downstream processing might mean. I think we've got to be realistic. Downstream processing means, if Lynas was continue to expand as a business in the next decade, that Kalgoorlie goes from cracking and leaching to maybe a little bit more. But it's not going to end up making magnets.
What do you think? What's your view on what Gina's up to between Arafura, MP Materials, Lynas, Brazilian Rare Earths? She's obviously got. Just the rare earths specifically. Is she, Trav said, trying to affect an outcome? Is she trying to,
I don't know,
be the global bloody rare earth supplier, or
what's 5% of Lynas worth?
Sure.
What is it?
I think it's a $3.5 billion company. So it's a lot.
150 mil?
Yeah, it's not much to her.
How much does Gina Reinhardt make?
She's got $19.5 billion of cash.
How much does Gina Reinhardt make a week?
Oh God! Well, if Twiggy makes $4 billion,
depends what the iron ore price is.
It's fuck all. Like totally.
It's a round of drinks, isn't it?
But she's not a substantial shareholder in many ASX listed companies.
No, but it's a round of drinks, isn't it?
Yeah.
But she's. Let me just.
So. There's two schools of thought, right? It's like,
$6 billion.
We're trying to do something, or bit here, bit there.
I don't think she's punting, but like she's. No. I think she's like. There's obviously a thesis that she's thinking of. And she's probably not thinking of the generations, because she doesn't want to give money to all the kids anyway. So, but like she's. Yeah, so there's obviously Arafura was ages ago when she got into that, but she obviously has some sort of big plan.
But Lynas and Mountain Pass are, they are, at the end of the day, as we sit here right now, those are your two big mines, and you wouldn't have thought it's going to hurt anybody if they end up merging. But there'll be people on both sides going, the price is not quite right. But
what do you make of Iluka as potentially a newcomer into the industry?
Well,
Eneabba seems to have a funding gap now as a result of.
Well, it's a big funding gap because the cost, and we've seen it through the quarterlies from everything in the last 18 months. The cost of doing anything in WA have just gone up and up and up. I mean, who thought 18 months to 2 years ago that $2,000 an ounce was the right price to be mining gold? I mean, you would have got laughed at. Well, now that's the number. So, Iluka, build that plant for, got a $1.2 billion non-recourse loan. Still got to pay interest on it. Now, the company's made some comments at a conference today that basically they've got to go and talk to the federal government again about, well, $1.2 billion is not going to build us the plant anymore. We've got the deposit, but $1.2 billion is now the wrong number. And is any Western government prepared to underwrite the price of rare earths? Because, it's gone through cycles in the past where, it's a much thinner market than, for example, something like iron ore or copper, and it gets influenced heavily, and right now it's in the toilet. So can Iluka afford to put up, a $1.2 billion non-recourse loan, top that in with another $1 billion of something, equity or debt of some description, and then sell into a market at $40 a kilogram for NdPr? Well, no, they can't. And besides, as we've seen with Lynas, learning how to separate out and refine rare earths is not easy. It's chemical processing, and so there could be some learning. There could be a lot of working capital headaches in that. So, maybe $2 billion is not even the right number.
Yeah, I wouldn't be surprised if it goes north. But does it make sense for there to be a complete rare earth refinery in Eneabba, and also in Nolans in Northern Territory where the government sort of allocated to? Or do you think there is like some natural consolidation that has to happen, and someone makes a decision that how do you have a better allocation of capital rather than have two projects run with massive cost overruns and government on the hook to fill the gap, etc. Those sorts of dynamics.
The natural course of things. You go bust.
Yeah.
People pump a whole lot of money. Or just look at Western areas.
Yeah.
We were talking about IGO 5 minutes ago. Stuck $1 billion in. Now what's it worth? That's life. So what's the difference with rare earths? Just because there's government loans out there to get stuff built, you get to the end, it costs you $50 a kilogram to make something, and you sell it for 40. Well, 6 months later it gets closed down, and it's a non-recourse loan. Well, too bad, it's written off.
I think the history of Lynas is an interesting one because as they had ramp-up challenges, they had continued support from the Japanese lending consortium.
Yeah.
And it's probably essential in their success in the long run, was that,
Yep. And remember, rare earth prices went through, various points in time when they were trying to ramp up. There's a couple of huge spikes in there as well.
Massive.
Well, that's exactly why the Japanese supported them, because of the tension between China and Japan.
Yeah, and then
Japan
also
thought we can't rely on China.
During that ramp-up period as well, didn't the rare earth price get crushed so much that Mountain Pass actually shut down?
Oh, yeah.
Hence, it's now become MP.
Yeah, it's private equity SPAC listing.
Yeah.
What about Bellevue? That's another company in ramp up at the moment now, getting there, towards nameplate. They announced just yesterday, off the top of my head, that they'd reached commercial production.
Yep.
What were your views on exactly? What were your views on
cost guidance.
The quarterly, and how do you see, to what Matty just said, cost guidance coming forward in the next couple of months?
Well, Bellevue is an interesting one from our point of view, because if you go back to the March quarterly, they generated about $20 million in cash flow. The company has a couple of $100 million worth of debt. The market has been speculating that they might need a small capital raise, 50 million, plus a bit more maybe, just to kind of wipe that out, get it going down. They generated $20 million in cash flow in the March quarter.
Yeah, that's including the trade receivables, but
but
not including the trade payables.
We're likely to get a bit more this quarter, and in our point of view, the ramp up looks like it's going okay. We'll wait and see, obviously, what the grades look like, over the next couple of quarters. To us, the swing variable, what a shock. It just is whether or not the gold price hangs in there at $2,200, $2,300 an ounce, and the debt very quickly disappears.
Well, look, it looks...
If it drops away, well, then obviously, then the debt doesn't disappear.
The leading indicators on that last quarter look really good in terms of what obviously the grade the stoping grade's going up, and then the development grade was like 9 grams a tonne, so the stoping grade will be higher than that. So that's all looking like it's going in a really good direction. Well, it's it's one of the best underground ore bodies in Australia grade-wise, but it's more, say, like, you know, a couple 100,000 ounces from 1 million tonnes, pretty impressive. But the costs are the interesting one. I'm looking forward to seeing, not the guidance, what they actually will be, because that, you know, everyone knows it's hard ground, and just seeing what the impact of that's going to be, like pulling all the ventilation raises through, which is bloody, you know, takes longer, it's more expensive, and just what impact that hard ground's going to, if that's going to be a little offset to the grade.
But I think
or not.
from an investor's point of view, once again, stinking great big high commodity price plasters over a lot of early problems.
Totally.
And if you've got $2,300 an ounce, divide 0.6, you know, we're at $3,500 Australian for an ounce of gold. You miss by a bit on your recoveries, you miss by a bit on your costs, the quarterly comes up a bit short. As with Fortescue all the way back there in 2005, as with Pilbara in 2022, you know, whatever working capital overrun, extra thing, extra bit, something gets clogged, you know, whatever goes wrong, if you happen to run into production when the commodity price has gone to the moon,
Tailwind.
From a financial point of view, yes, the engineers have got headaches, and the, you know, equity market participants are just simply going, well, yeah, but what was the gold price 3 or 4 months, 6 months ago? Sub 2,000? It's added $300 an ounce US, you know, big dollars. So it's more than $500 or $600 an ounce, and that just covers up when you're in ramp up, like Pilbara a couple of years ago, like Fortescue, you know, 15 years ago, maybe like Boss and Paladin now. You couldn't have picked a better time to flick the switch, because the biggest headache's the working capital. Because, you know, when all of those things you're talking about go wrong, and you got 1,500 people, well, obviously in the case of a gold mine not, but you got hundreds of people running around, you got to pay their wages, whether the plant is producing sand or something you can sell.
Yeah, it's going, once they start mining that Deacon lode, they're going to absolutely print cash. It's just,
well, as long as
getting to that point.
As they get there when the gold price is hanging in there.
How do you view the end point of the investment here? Because it doesn't sound like what you've just described with IGO, where you're quite bullish on, you know, perhaps a medium-term lithium price. You're playing the sort of re-rate and the de-risking of the business as it kind of gets through there. Do you have like a NAV value in mind, or how do you see it playing out?
It's just so hard to know, because you say, well, yeah, you get add value, and then the trick to all these things is just, you know, from a financial point of view, whether it's paying down the debt, whether it's chewing through some horrible deal you had to do to sell your offtake, and then the price spikes and you're selling into something you wish you didn't have anymore, but you had to do it because the bank said you have to do it. Otherwise, you didn't get the loan, and you've hired contractors that you're paying too much for because you didn't have the money. You know, there's just a whole laundry list of stuff you do when you're getting these things up and running. Consequently, in this case, you run into a 2,300 and something or other dollar an ounce gold price and a 65-cent currency, and you just get to burn through all these problems and get yourself set up. What does that give you in the end in terms of, you know, a share price and a value? A broad range of things, but you'd think once you've burnt through all that stuff, just more, a lot more.
Do you think if they execute this without a raise, get the debt paid off? So I think from memory they were forecasting something like 400 mil EBITDA. So that'd, if they get the re-rate on the back of that, that'll put them at, you know, over a $3 billion company if they trade, because what they are now, they're probably trading around 4 times on that thing. So, that's obviously
that
a bit
EBITDA
of
is so much better when you've got a higher gold price, though. Right?
Oh, yeah. So it could be a lot.
That's
more,
right.
Yeah.
So, you know, whether you're talking a lot more, a little bit more, or will largely depend on, you know, gold price and Aussie dollar. If you guys could just keep the cost of doing things in WA down a bit, that'd be quite handy as
Those
well.
bloody jumbo operators want to get paid too much, mate. What do you think about their growth? So, you know, they're in depletion mode now. They've still got to do a shitload of drilling, so there's probably a lot of organic opportunity at Bellevue. But what do you think about knowing who the team are, where they've come from? Let's look at. I mentioned Jundee the other day. Looked at the declining grade of Jundee over the last 4 quarters. Do you think maybe they might look at some inorganic opportunities, pulling stuff back out of Northern Star, or do you think they're going to really just focus on Bellevue?
I mean, you guys just look a bit further down the track than we do. We'd rather they just got Bellevue working. The biggest value upside in our view in the business right now is just get the thing working, generate some free cash flow, pay down the debt, and then just over the next 18 months, just optimise the plant and the costs and the mining. And you know, I think from our point of view, from an equity market point of view, you know, for want of a better term, I mean, people keep telling you, "Oh, I just want certainty." Well, you can never have certainty, but the reality is people will pay a lot more once the thing is operating in a small band and just operating. And so for us, right now, looking at where that mine's at, it's about near mine opportunities and getting the thing working properly and starting to generate all that free cash flow, and then people will pay for it. And then after that, well, then you start to work into the realms of, you know, what do they run off and do next? I mean, one of the nice things about a listed equity market is that you can also choose, if you start to think, no, I don't like that, well, you just take your money and run at that point. But that's thinking more than a couple of years down the track. And when you think about how hard it is to get to where they've already got to, there's a lot of hard operational work to go. But to us, a lot of investors just kind of they'll pay a lot more for something that's just working and operating, and they're not quite there yet.
Mate, you want to talk about certainty?
There is no certainty.
Certainty, no better transition to Deterra royalties. You're just certain to get a 6.3% fully franked dividend on it. But why have they got 5 people on the board and like another 8 key personnel attached to something that just takes a royalty in?
Matty, you weren't even in our chat yesterday with Gabriel of Sand, and we had this exact conversation
really?
with you.
Yeah.
Well, something like, what is it?
12 million a year to run the shop.
I think last
Deterra.
half was like
Deterra,
5.3 million in operating costs and staff costs. Like hey, there's still a shitload of EBITDA, but
Yeah.
yeah,
I mean, what was
Run a
it?
post office box.
yeah.
So why do you hold the business?
Deterra?
Yeah.
Oh, because we just, at the end of the day, we're a small mid-cap investor.
Yeah.
And there is no iron ore in our space. Well, there is, but
Yeah,
we're not fans of much of it.
yeah.
So we have a business that, you know, yes, as you say, could run a bit cheaper if it wanted to, but every single business could, and is exposed to large, low-cost mines that dominate the world trade.
To that end, the bullish iron ore bet, I'm interested to hear what you kind of think steel, global production, these sorts of things. It's inextricably linked.
I mean, you know, you can read studies that are this big. At the end of the day, cost curves, it's sitting on top of low-cost mines, big ones with long lives.
So what's the contrast of holding Deterra versus BHP?
Well, we're a small mid-cap investor. That's just a little bit beyond
So
our remit.
Yeah. So the
don't have
mandate
that-
is
we don't have that choice.
is in that thing. Yeah.
There
I
are
gotcha.
other funds out there that invest in a completely different way than we do, and they own BHP and Rio and Fortescue, and
So it's a pretty you consider it a pretty safe. Like it's a good one to have in the portfolio just because of
I
a
think
bit
so.
of certainty.
yeah.
Would
Well,
you
you're exposed to better mines than in iron ore than we can get exposure to in the X50 in the small caps.
Yeah.
Would it be within your sort of style to encourage management to look at cost at any point, or is that just not how you operate?
No, that's
Yeah.
We do take corporate governance and, you know, suggesting things to people seriously, but we've also got to be realistic. We're a small, nimble, small cap and mid cap investor, and having people like us ringing up and suggesting things to companies, you might as well pick your battles that you realistically think you can, influence an outcome. And if you don't, and you're unhappy, unfortunately, the only way to kind of resolve it's to sell your shares and go and find something else.
Would you like to see them do a deal or just continue?
Don't really have a view. We're just perfectly happy with how it is right now.
Yeah.
How about
Put it this way.
What deal would
We'd
they
like
do?
them to do a good deal, but how the hell do you know what the hell that means?
What sort of deal would they do?
There's no
like
they
just
can't
a
do it. They can't do a deal that's
non-controlling.
better than what they've got.
Yeah.
Like, there's no better royalty, and if you bid for anything, you have to pay through the roof. You can't outcompete. You've got a worse cost of capital than the other royalty companies.
Well, then there's that. And I mean, do you guys remember back to
They should buy the haul road. Minra's haul road.
infrastructure. Yeah.
what was the predecessor to Iluka?
SSR. No.
Alassa, the gold.
The WA bit that went into Iluka. It had an underground gold mine
the
in
Higginsville, that was Avoca, wasn't it?
Avoca.
Yeah.
Well, remember,
There was like two sets of
they'd
royalties
sold their
attached
royalties to Morgan Stanley. And people went along every single day of the week and said, when are you going to buy that back so the company will make a bit more money? Well, in that simple statement is a conundrum. Morgan Stanley are not going to sell it because they're making so much money out of it that in order to sell that thing out, you probably have ruined Avoca on the way through. So you're stuck with it. So the flip, with Deterra is, well, you want them to go and do something, but do you want them to pay through the nose for something, and then, what you've got there right now is wrecked.
Yeah.
I just want them to do something to justify how many fucking people work there.
Well, you can just make it private, unlisted, fire all the people, just happy days. Yeah. Anyway.
Maybe we'll go 249D.
No, we can't move the dial there.
How about Boss Energy and, chat a bit about uranium maybe getting pumped?
How good's the yellow cake?
We were pretty intrigued over the past couple of months as they were getting to first drums, as they call it in uranium land, and there were a couple week hold-ups along the way. These things always tend to happen in ramp up.
Talk about Boss and Paladin, or just
Boss.
We'll start with Boss to start. So how do you sort of see it now in the valuation that they trade on? Obviously they've got the Texas project coming online quite soon, but it's still a while's way before they get to
it's
steady
slow.
state.
the ramp up slow.
Yeah.
Slow as in it's known, but it's going to take a while.
Yeah.
Look, I think once again, coming back to some of these threads that come right through this, Fortescue, 2005. Where are we at with lithium right now? Well, we've had our monumental price spikes when you suddenly need more than is available 2-3 years ago. Now, you then roll forward to uranium, where we've got a situation where, and once again, there's a couple of papers on our website that David's written that go through this. We have Fukushima. The world was thinking this is a good idea. It was obviously way earlier in the decarbonisation passion compared with where we are now. But we have $80 to $90 a pound for uranium. Fukushima happens. 2017 we hit the bottom, and we're at sub 30 depending on the day of the week you picked. We're not a single uranium mine in the world is, maybe apart from a Russian stockpile, is economic. And ever since we hit COP26 and we've got your renewables up to 25 and 30% of people's power grids now, and depending on your point of view about where this goes, if you're going to really chomp into baseload power, and a country like Australia is completely coal dependent, others are a mixture of coal and uranium already. I mean, the US is 20% uranium already, or nuclear already, and you're starting to see the costs of getting the renewables from 30% to 40 or 50 or 60, in the years ahead getting harder. And the world's flat out building reactors again. We get COP26. Nuclear gets felt out a bit. Then we go to COP27. Then we get COP28. Everyone signs on the dotted line and says, yeah, this is what we've got to do. Meanwhile, sitting in the background, you've got EVs which have come up. And now, even more significant perhaps is the data centres, where if you now want, on a US scale, to run a clean, green, 6-star data centre, you almost need the reactor next door. That's where we're headed. I mean, the data centres that NextDC want to build here, forget even bigger economies. We're going from 2 to 5 megawatts. The ones they want to now build, not on the drawing board yet, but the next drawing board are 200 and 300. In fact, or bigger. We've got this conversation going on in New South Wales now about Uranium, which is 2.6 megawatts. Well, it's not inconceivable. You're going to have a data centre build, somewhere in the Sydney basin that will chew up a quarter of Uranium's capacity. And that's assuming, of course, the New South Wales government pays to keep it operating. We've had the same thing happen in Victoria with Yallourn and one of the Loy-Yangs. They've got to be kept running. So, we're in this whole discussion now, whether it's EVs and data centres and AI, as to whether, in fact, electricity's gone from the world's most boring utilitarian type industry to actually needing to grow. So even depending on how people manage to, cope with the cost of renewables transmission and renewables, storage, however it is you do that, you might need it all. So what are your choices? Pay to keep the coal running, whether you're here or in Germany, and build the new renewables, or what are you going to do? You're going to sit here in 2050, double the scale of renewables in this country, and still have the coal-fired power stations running? Because the data centres have come along and gone, hey, where's mine? Or do you want these not to work?
I think the world's just got to accept, which is because every option is like this big deficit. If all this has happened, they need to accept that there is going to be a piece of everything for a very long time.
That's right.
That's what we think. Service it,
and probably, and if you look at the signatories to COP28, the one technology that's now getting heavy reinvestment in it is nuclear. The reactors will get better, smaller, better. There's more investment now going into it, which completely stalled. You can see that in the uranium price that hit $30 a pound in 2017, 2018. At $30 a pound, no one's interested. At $90 a pound, it's telling you that, there's demand out there. And on top of that, we've now got this geopolitical situation where, unlike rare earths, for example, it would appear that whether it's US reactors or maybe French ones, the West, geopolitically, the West is not happy about buying enriched uranium from Russia.
When will we see nuclear power plants in Australia?
You tell me. What do you think?
What are we thinking? What do we hope?
Oh, we've got to bloody get to mine it first, let alone put the reactors there. Yeah. Have you got a if you're in the small cap space, do you look at that WA uranium mining ban as a bit of a call option on that getting changed one day?
I don't think that's true, by the way. I don't think you have to necessarily allow the mining before, they
but
can
if they're
be
not going to
different.
allow, yeah, I know, but if they're not allowing the mining over there,
but once again,
you are getting a reactor.
Get into production at the right time. So when it all goes wrong, which it will, make sure you got a sky-high price with which to smother over all your cracks. And therefore, at $90 a pound, in our view, you can have the best mine in the world, and if it comes on stream when uranium's $30 a pound, you're going to go bust. And you get parked, and then as an equity holder, you get wiped out, and then half a decade later, someone gets to have another crack because the mine doesn't go anywhere. But from an equity holder's point of view, the interesting thing about Boss and Paladin as well, right here, right now, is that they're both starting to deliver drums. In the case of Paladin, you know, in the June quarter, and in the case of Boss, you know, sort of shortly thereafter, but it's happening. And then they've then kind of got, well, you might say lucky. I'm sure the management would say it's good management. You know, they've now got their 30% stake in Alta Mesa as well, which it's going to go into production at some point later on this year. So they get double up. And they get to start selling their drums, their early drums, at $90 a pound. And they've got contracts, and the Russian bands come in, and the Kazakhs are suddenly having problems with their production, and Cameco's not exactly shooting the lights out. And right back to that whole discussion we had about your WA situation, if it takes 3 years from go to woe to get a lithium mine up, how long does it take to get a greenfields uranium mine up right now? 2030? 2032? 2028? Probably 2030 at least, because you've got, you know, the worst permitting, the worst environmental standards, the worst of everything, all the, you know, for want of a better term, you know, the misinformation around uranium and what it means and what it can do, and, you know, is this all just going to end up in an atom bomb? Well, you know, it's going to be very hard to permit. So it's, to us, once again, it's about the mines that are getting into production now, and they've got the timing right. There'll be more uranium because the price is now going to stimulate more. But the earliest next mines that you're going to see, whether it's, you know, is it WA needs to change the rules? Does the federal government need to change the export licenses? Do we just not want, you know, what happens to Russian uranium? It's a much harder commodity to smuggle, by the way, than oil. You know, you're not going to, I mean, you know, all the oil in the world's still pouring out of Russia. It's just, you know, moving around the place and it's finding a home. What about barrels of uranium? You know, will a US utility sort of have uranium fall off the back of a truck well, no, they won't. That's just not going to happen. But so anyway, back to the mines. Right time is now. The right time for lithium was a couple of years ago. The right time to get your iron ore business launched was 2007. But the lead times for these things are long, and you just got to get there at the right moment. Bellevue, surely the right time to be launching a high-grade gold mine is when the gold price has suddenly popped up $300 an ounce, because if it came out at $1,800 an ounce, we might end up with 3 capital raisings and 6x on the bloody share count, and the whole thing's a disaster. But the mine's fine. But you end up with less share count, less debt, an opportunity to generate some cash flow, and then get your costs down by reinvesting in your processes, your business, your infrastructure, your own mining fleet, you know, all the things that cost you money. Get rid of your bloody the offtakes you've had to do, which are at a terrible price, bad terms and conditions, you know. So I think the nice thing, once again, about Boss and Paladin is the industry's taken off. The world is building reactors. The supply of uranium out of, you know, the other side of the geopolitical divide looks like it's going to be problematic. And along comes Boss, based in South Australia, licensed in production, and Paladin with 75% of the mine in Namibia, which in Africa is about as good as stable as it gets. So once again, I think the theme, you know, for us when we're looking at all of this is right place, right mine, got to be the right time.
So it sounds like the way you're investing is not thinking too far ahead. It's like, right, who's going to make money in the next 2 years?
Well, yes, and it's not to say that if you get if the timing is just a bit wrong, you don't eventually get there. But from an equity market point of view, you get there with triple the share count. Or you get there with, if you get there with triple the share count, you get there. If you get there with a pile of debt, you often go bust. And then you get shut down, and then the debt gets wiped out, and like the third owner of the hotel, the third owner makes the money, not the person that built it. And the nice thing about some of these commodity cycles we've seen over the last little while is that if you get your timing right, you get to get rid of all those things you need, all those deals you need to do, which actually are just basically whether it's an offtake or an appalling interest rate on some debt, or you're just sort of selling off part of the business. And a high commodity price gets you the opportunity to get that part of your business back without having to
Deplete your resource too much either. Yeah.
Western areas, perfect case in point, right? They've had two of the best nickel mines that anyone's ever found. And what's happened? It's now been written off. Why? Because the nickel's been mined at sometimes $2.50 a pound. And all you were doing was mining below cost and constantly raising money out of the equity market. And then suddenly, at $8 a pound, Flying Fox or Spotted Quoll are probably fabulous, but not at 1,400 metres. But imagine if you'd shut, it's all spilt milk, right? Imagine if you just went at $3 a pound 15 years ago. Let's just shut this down. Shut it down. At $8 a pound, Spotted Quoll at 300 metres is probably making a poultice. Even in this world of nickel that we've now decided is a disaster. But the problem is, exactly your point, you've depleted it because you were mining at the wrong price. It's very, very hard to go and tell a mining company, though, just to
Sit on it.
pack up and wait half a decade.
No, you can't pay yourself a juicy performance rights for doing that.
I think didn't Hoffy look at it when we were saying like Nova's like a rock factory and they printing cash, but I think when they added up what they paid for it, and like Nova, all the cash that come out of Nova didn't pay what they paid for off what they paid for it, effectively.
Yeah, or it took.
You're at quite a negative if you have to pay a huge amount to get it. If they had been the ones that discovered it, it would have been great.
Would have been, yeah. So even though it's printing a bit of cash, it hasn't been a good investment.
So, uranium, we think investors will pay more for Paladin and Boss if you've still got an $80, $90, $100, uranium dollars per pound sitting there in 6 months or a year's time and their productions come up, people will pay more for them.
Do you reckon they'll get hungry on the M&A? Or do you reckon they're going to be, as you said, pretty similar to what you want to see Bellevue?
Sort of gone once already. It's possible, but you would just hope that the challenges in the next 18 months are all about getting in production, getting the first drums out, getting the cash receipts in well before the end of the year in the case of Paladin, and third quarter in the case of Boss.
Yeah, and Boss doesn't have debt. Paladin has a little bit, but not heaps. But
well, and also Boss is sitting on
the inventory and the cash.
The inventory as well.
I think it's 400 million in liquid assets.
Something like that.
Yeah. So what do you, there would come a point where they'd have to distribute some of that, you'd think, if they don't buy anything.
Who knows?
Yeah.
Who knows?
Yeah. Well, they
straight into your pocket, mate.
It's also flexibility, right? If like meeting their contracts, if they have any ramp up woes, but your inventory comes in handy.
Yeah, but they're only like 20% contracted there. Most of they're very exposed. What do you think about the opaqueness of the term contract market? Tough to get
uranium.
Tough to get info anywhere.
Yeah, it is. Because, at the end of the day, to be fair, you're dealing with utilities who need
certainty.
Just certainty. So they set up a long-term contract, and what does the spot market for uranium actually mean anyway? When you've got people on the other end who are running power stations.
Yeah.
What does that actually mean? So, but there is a spot price.
Yeah,
but more the opaqueness of the pricing, like you can never get a Cameco they're the best at spinning it, but you just never know what. I know there's multiple contracts that get laid in as you go, but you've just never got projection on what they're going to, where they're sitting.
Well, the only thing you really know at the end of the day is, I guess, once companies get into production, you can see how much they've produced, see how much they've sold, and see how much revenue they've got.
Yeah.
You know at that point.
Yeah.
The last one I want to touch on really quickly is Whitehaven. You spoke briefly before about it, but can you just sort of speak to what you see in terms of the valuations, or the valuation of the company, and perhaps
we really like what they've done. Our history with Whitehaven puts a smile on our face. We were owners of it when it de-geared after the... I'm trying to remember exactly what happened now, whether it was the consolidation of the Hunter assets. They geared up, they de-geared. The share price went for an almighty run, and I'm sure the commodity price had something to do with it, but it's 2015 from memory. That happened again when obviously the coal price went through the roof a couple of years ago, and they hit a production sweet spot, so the company's gearing just collapsed in basically the space of 6 months. And we're hoping that the same thing's about to happen again. They've, if you measure it by revenue, they've just tripled the size of the business with the acquisition of BMA's, 2 big met coal mines, or 1 big met coal mine and 1 medium-sized met coal mine in Queensland. The debt is currently sitting at around, whether it's net or gross, between 1.25 and 1.5 Aussie. And at some point in the next 6 months, they're likely to announce the sale of, 20% of the equity in Blackwater. Optimistically, you'd hope they get something close to $1 billion Aussie for that. Might be a bit less, but you put that in, and all of a sudden you got sort of $500 million worth of debt. And every single day now that the met coal price hangs in there at $245 a tonne, the thermal coal price, with the Hunter assets, hangs in there at $140 something a tonne, which by most pundits wasn't supposed to happen. It was supposed to be 120. And you only have to start looking at, obviously this is pre the equity stakes that people have in their Hunter assets, but 15 or 18 million tonnes and add $20 US, so 30 small dollars. Times it through, look at the debt, just collapses. So we think with Whitehaven, it's been a great deal they've done. And every single day, the 2 coal prices hang in at the current levels. The rate at which this company will de-gear, particularly, if you include the sale of 20% of Blackwater, they could be back, in our view, within a year in the position they were in, except they're now, more than 2/3 met coal, 1/3 thermal coal, which is optically also for a company a much better place to be in, because you've got, we talk about the transition, which we all talked about earlier.
Met coal is a critical mineral.
Or met coal.
It is.
Met coal is a critical mineral. Electricity, by the way, is more critical than all of it, because without electricity, we actually have no economy at all. So, thermal coal is going to be part of the mix until the transition of base load power or vast amounts of renewable storage that we can't currently envisage is somehow dealt with. And, it's not a 2030 problem. It's probably not even a 2040 problem. So you're going to have thermal coal, high quality thermal coal in the mix, we hope, for some period of time to go. And if you get thermal coal prices north of 120 US a tonne for sustainable periods of time, and or met coal, which is essential for steel, you've got a de-gearing of the Whitehaven balance sheet at a rapid rate, and you end up in net cash pretty quickly. And those last 2 businesses probably are a different metric to what we've consistently talked about on the way through here, which is right mineral, launch at the right time. they are large businesses with competitive cost bases and huge amounts of cash flow trading at low multiples. You know, free cash flow yields can very quickly get above 10% with franking. Very quickly.
Yeah, it's fascinating. There's no businesses other than the hydrocarbon businesses which
now have huge yields, franking,
massive yields. Yeah, it's like, I think, you know, one of the probably advantages of being active capital in this time where a lot of other capital is mandated to avoid those hydrocarbon businesses, probably doing themselves a disfavour.
Well, particularly when, met coal is, and I think there's a recognition, whether you want to bundle it in as a critical mineral with rare earths and lithiums and things. The reality is, it is critical. Without met coal, there is no steel. And yes, the future may well have green steel and, various ways of attempting to produce that, but, look at the size of the world steel industry. I mean, a couple of green steel plants are going to show the way for what, may well happen, but what sort of timeframes are we talking here? To convert solar into something, and then end up with, with steel is, in the scale of that industry, is a way off. So for the foreseeable future, it's met coal is critical for steel.
Trav loves it.
Mate, you need a lot of met coal in your EVs. No one wants to talk about it.
Right now, you need a lot of thermal coal in your EV as well.
Totally. Totally.
Yeah. Oh, very good.
Thanks for making the time and coming on Money of Mine, Stephen.
Good
Too
one,
easy.
eh?
To summarise,
Nice to meet you guys.
Buy mining companies when they're building their mine and they're going through the tailwind, the commodity price at the top.
Tailwind of the commodity price, and don't kid yourself. The commodity price always lasts.
Yeah.
And the trick to it is to get the debt paid off, the operating costs down, the take or pays dealt with, the high interest loans paid off. And if you can get through all that while the commodity price is high, now obviously iron ore was a big gain, but you got Fortescue, which share price did not peak in 2007 or 2009 or 2011 or 2013. It's,
2024.
It's just kept, well, there you go. It's just kept going. And that's what happens, or that's what can happen on obviously one of the biggest commodities in the world. When it goes right for you at the right time, you end up that business. And Greenbushes, Pilbara. Let's see what's about to happen in uranium. And, the advantage you get, in our view, from right place, right time, right commodity price, right now, the advantage you get, if you look at the example of Fortescue, might last 15 years. In fact, you might never catch them.
And if you're the biggest shareholder, you get to keep all your shares. Like Twiggy with his 36%.
There you go. Because if it had gone wrong, and he'd had to get other shareholders and had to do ongoing capital raisings, he wouldn't end up owning that much of it. He would have owned a very, very, very small amount. By the time
that's the most
share count
impressive
goes
part.
dump, 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 dump.
Yeah. No, very good, mate. That was good fun.
Thank you.
Hopefully you enjoyed it too.
Hooroo.
Hooroo.
Righto, there you go. Bloody, that was good. I like a bit of back and forth, a bit of arguing. I like that.
People
knows his shit, old Steve.
There was some tension, but I think we navigated it, and it was actually a really satisfying conversation by the end.
Bloody
of it.
good.
Yeah.
I like a bit of bloody different opinions.
Yeah.
a bit of backbone in people's beliefs. It's good.
He probably thinks, what do these young pricks know?
He's
probably
actually right.
Thanks for coming on, Steve. Thanks to Eiger Capital for it. And thanks to all the partners. Talk about Go Australia, DSI and K-Drill.
Yeah.
Mate, who else we got?
VRIFY.
VRIFY. They're getting into Australia. Anyone in Australia wants to work for VRIFY, give VRIFY a call. GetWet Solutions. Oh, that's Australia. Bloody Silverstone, CRE Insurance, WA Waterbores, and too. This is Australia. Brooks.
That's That's it.
Brooks Airways.
And get on Spark while you're at
Get
it.
on Spark for your bloody charts and market data for an active ASX trader. Hooroo, money miners.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.